So I want to start this one differently, not with a chart, not with a yield figure, but with a street. Now, whilst I'm still a UK tax resident, I live in Barcelona. And if you walk through almost any neighbourhood here, the Gothic, Gracia, Eixample, or the seafront, you'll see people smoking and a regular stream of people entering any of the many tobacconists. Young people, old people, groups outside of bars, people on their morning commute. It's not a relic. It's not declining. It is just there in plain sight every single day. Now, this video is for educational and entertainment purposes only and does not constitute a financial advice. I'm not a financial advisor. Always do your own research before making any investment decisions. So Peter Lynch had a phrase, invest in what you know. And I would add to that, invest in what you can see. And what I can see every time I sit outside a cafe in this city is people buying and using tobacco products. That observation was part of what led me to buying British American tobacco. Today I want to walk you through exactly why I hold it, what the numbers look like and where the risks are, because there are real ones. So British American Tobacco is one of the largest tobacco companies in the world. Brands like Lucky Strike, Dunhill, Camel and Rothmans sit under its umbrella, and it operates in more than 170 markets globally. The business model is straightforward and has been for over a century. People buy tobacco products. Those products carry high margins. The cash generated funds the dividend. That is the loop. Yes, volumes in the West are declining. That is real. But BAT has two responses to that. Pricing power, they raise prices faster than volumes fall, and a growing next generation products division under the Views brand, covering vaping and heated tobacco. And beyond the West, across Asia, Africa and the Middle East, and yes, Southern Europe, volumes are not falling in the same way. The Barcelona streets I mentioned are not unique. This is a global business with a very long runway. So here's where I sit. I hold 308 shares in my ISA at an average cost of £31.50 per share. Total book cost at the time of recording this is £9,703. And that position is worth £15,064. That's a capital gain of 55%. Now I have a rule. Sell the growth in positions once they reach 100% gain and redeploy into income. Now BAT is sat at 55% gain. So am I watching the door? Well, not right now. I've been listening to an argument that you must let runners run. And more importantly, I've caught myself buying and selling too much recently. I wanted to get back to the original mentality of set and forget, count the income and let the machine run. And the income is the point. Over the last 12 months, BAT has paid me 4 quarterly dividends, £166 in May of 25, £171 in August of 25, £171 in November and £173 in February. Most recently in May of 26, £186. Now in total that is £867 in cash income from a £9,703 investment. And since I opened my ISA, I've received a total of £2,058 from BAT in dividends. Now that's a return on investment of 21%. I also run a £100 per month drip into BAT. That is buying roughly 24 additional shares per year at the current price, and that's quietly compounded in the background. Now before I buy anything, I run it through a simple set of questions. Can the business generate cash? Can it pay and sustain its dividend? And does the income justify the risk? Now on dividend cover, the annual dividend per share is £2.45. Earnings per share are £3.49. That gives the cover ratio of 1.42 times. I will be honest, I normally want a minimum of 1.5 or better before I feel comfortable. This is tighter than I would ideally like. But the EPS cover is not the whole story for a business like BAT. Tobacco generates exceptional free cash flow. When I look at the free cash flow figures, the dividend cover on that basis was far more comfortable. And that is where I took my confidence. The current yield at the time of recording this is a little under 5%. That sits below my usual ISA target of 7% or more. The reason is simple. The share price has risen strongly over the past 12 months, and a rise in price compresses the yield. The dividend has not been cut, the income keeps coming in. The maths just reflect where the price is now. So does it pass? Yes, on the free cash flow cover, on dividends delivered, and on the consistency of the payment, quarterly, reliable, and grown. Now I'm not going to pretend that this is a clean story. There are real risks and you deserve to hear them plainly. First, Western volume decline. People are smoking less in the UK, the US, and Western Europe. That trend is real and it's not reversing. BAT manages it through price increases, but there is a ceiling on how long you can raise prices on a declining user base. Secondly, regulation. Now I'm not a fan of big government. Let adults make their own choices, good or bad for themselves. The US menthol ban has been discussed, delayed and argued about for years. If it ever lands fully, it matters for BAT's US revenues. Regulatory risk is a permanent in this sector, but when big tobacco pays Trump $5 million, and 5 days later the FDA cleared flavoured vapes. There are a number of words that spring to mind. Feel free to drop yours in the comments section. Thirdly, debt. Now, BAT carries significant debt from the Reynolds American acquisition. It's been managed down, but it is a watch point. Higher interest rates make debt more expensive, and that competes with a dividend for cash. I hold it with those risks fully in mind. They're not surprises. They're priced into the stock and known by every investor in the space. So with all of that said, why am I still in and holding? Because the dividends keep landing quarterly, without fail, and it's grown. Look at my own numbers: 166, 171, 171, 173, and 186. That progression is not dramatic, but it is consistent. The business is doing what I bought it to do. Because the income return on what I actually paid, 8.9% per year, and 21% total return on investment at the time of recording this on book cost is strong. That number does not care what the share price is doing today. That is real cash received in tax-free ISA wrapper. And because when I walk the streets of Barcelona and watch what people are actually buying, not what the headlines say they should be buying, tobacco is still very much part of the picture. The streets don't lie. The dividend does not lie. And I am holding. So to close, if you are building a dividend portfolio and you have not looked at BAT, it's worth putting on your watch list. Do your own research, obviously. The risks are real, and this sector is not for everyone. But for income investors who can hold through the noise, the cash flow case is hard to ignore. And if you are investing in an ISA and you're not yet on Interactive Investor, the link is in the description. It is the platform I use for both my ISA and my SIPP. And I'll see you in the next one. And until then, bye-bye now.